So in this video, we're looking at the causes of Australia's current account balance, including the cyclical and structural factors. The Slater design says that it's a deficit because it was written in 2017, and for a long period of time, the current account was in a deficit. But now we know that over the past few years, it's reached a surplus. So we're going to examine this area of study as a balance instead. As a reminder, this is what the current account basically looks like. And remember that we are tracking transactions that have no future obligations. So if you're making an interest payment, for example, you're never going to see that money again, or you're not affiliated with that money again, and so it's gone forever. If you're simply spending on international goods or services, that money is now pretty much gone, and there is no future obligations attached to those type of payments. What we've also done is that if you add all these different columns up, different categories, if the total value is a positive, the current account is then classified as being in a surplus. And if you add all these numbers up and you get a negative number, then you're in a current account deficit. And so what does a current account surplus and deficit mean? If it's at a surplus, it simply means that our incomes are greater than our expenditures, or our credits are greater than our debits. And if we're running a current account deficit, it means that we're spending more than we are earning, which means that our debit entries are greater than our credit entries. It's important to note that the current account balance can be displayed in two types of ways. We can look at it at nominal dollar terms, which is what we're seeing in this column here. And it can also be expressed as a percentage of GDP. So we weigh up the nominal values of the current account balance with the nominal value of GDP, and we just simply derive a percentage here. And then if we're tracking the percentage changes over several years, we can tell if the current account deficit, or current account balance, I should say, is increasing or decreasing over time. And so with that, you may be faced with different types of trends as well. So this one at the top here relates to the percentages of CAD in relation to GDP. So you're getting a line graph that looks a bit like this. And if it's displayed in nominal terms, then you can expect maybe a bar graph like this, and this is tracking it in millions. So if we're looking at this, for example, the latest quarter tracked a $12,677 million current account surplus, and 12,000 millions is the same as saying 12.6 billion. So the main focus of this video is looking at the structural and cyclical components of the current account, and there are two keywords that we are looking at. Structural is related to the long-term trends, while the cyclical is anything that relates to the fluctuations that occur in the business cycle. And as we know, the business cycle is directly related to the fluctuations in aggregate demand. So let's take, for example, we're tracking someone's budget, and his income salary is $2,000 per month, and he spends his money on all of these types of things every month as well. Now what we're noticing is that for some entries like entertainment, groceries, and retail, if we're tracking that same spending over the course of the 3 months, the dollar amounts are always changing. Okay. What we also see is that there are certain transactions that might only appear in certain months. Okay, so if someone has suddenly booked in a dental appointment and he's required surgery, he's then going to add this negative $1,000 into his monthly budget. And as always, what we're seeing at the end of each budget, he's getting a balance. So in January, he's, I guess you could say, saved an additional $270. In February, $570. And in March, he's actually spent more than he's earned. Now, spending more in a month is not necessarily a bad thing. And in this case, we can see that he's probably allowed to spend more in this particular month because he's saved from the previous months prior. Now, the next key thing that we need to recognize is that there are certain transactions that are pretty much consistent throughout each separate month. And they're also always relatively the same, well, exactly the same dollar values. Okay, so this person spends internet bills every month $100, phone bills cost him $150, his rent is $500 per month, and his gym membership costs him $80. Now, what's the point of looking at this? We can compare the differences between cyclical and structural components of the current account by using this example here. So the transactions that fluctuate throughout month by month would be the cyclical, and the transactions that occur consistently and that are, I guess, considered the long-term types of spending is going to be the structural components of his budget. And so what we're required to do in the VCE space is we're looking at what are the types of long-term transactions that will typically always occur, and I guess reveal why they occur, and also what are the most recent types of cyclical changes that have helped maybe improve or worsen our current account balance. So in this video, we're focusing on structural. So the structural account is primarily focused on the net primary incomes. Okay, and as a reminder, net primary incomes relate to the flows of profits and interest. Okay, so for profit, it is usually about equity payments, right? Because if people are investing in our country, we pay out profits through dividends. And if we are borrowing money, we pay interest. So if we've borrowed 50 million from an international bank, in the future, we're required to make interest payments. And so for Australia in particular, we have two structural problems, and it is summarized by our savings and investment gap down here. And what that means is that Australia has been highly dependent on overseas loans, and loans is referring to debt, okay, to finance local consumption and investment. And we also depend highly on overseas investments, which are equity transactions. And so how does this actually affect the current account? We're going to be using a visual to demonstrate how this all is linked. So remember that we're looking at the structural components of the current account, so make sure that the focus is on the left side of this balance of payment. So as I've mentioned, we like to source funding from overseas. And so if we're selling equity in the capital and financial account, this is going to be an inflow through the net portfolio investments transactions category. And if we're taking on borrowings or if we're taking on loans, then it's going to flow through the net debt flows. All right, so what we're ultimately going to see is that the CAFA is going to experience a credit entry. And so once we source these finances, this doesn't happen for free. In the future, we're required to make payments, and these can be profit payments, which is through dividends, or it could be interest payments, and that flows outwards through the current account through the net primary incomes transactions. And so because we make these payments, we make these outflows, there's going to be a debit entry on the current account. And so if we're reviewing the total current account, and let's ignore these for a second, if we're financing a lot more, which means that we're required to make far more outflow payments, then what we're seeing is that if this is the only thing negative, and this is and all these other accounts are zero, then we are going to be sitting in a deficit, which is why if you look at historical trends, a lot of our current accounts for many years was always in the negative values or the deficit. So this video wraps up the structural component. In the next video, we'll be looking at the cyclical components that affect the current account.